We're live.
Right, very good. Are we live on social media too?
We are not. Maybe we'll put it out afterwards.
Okay.
Very good. Welcome everyone who's joining us right now. We'll be getting started in just a few minutes. Glad that you could join us. And for anybody who previously submitted questions, thank you very much. Those are helpful, and we've kind of consolidated those. And so we will have a Q&A session here afterwards. So you can use the Q&A little box at the bottom of your screen to post those questions. We were just talking, it's probably between the slides that we're going through and the questions that were already answered. Chances are your questions will probably already get answered sometime throughout this. But if we get towards the end of this and you still have a good question that you don't feel got answered yet, feel free to throw it in that Q&A box and we will address it as we can.
Absolutely. We like audience participation, so thank you for doing that. But it looks like we are at 11:30, so we'll get started.
Very good.
All right, welcome everybody officially as we are here in April of 2025 and in the midst of a market correction that we didn't expect, not that anybody can ever expect, right, one of these to happen. But nonetheless, we did our market forecast back in January, which many of you listened to or watched, or maybe you've even attended a live event. But we thought it was warranted because of all the volatility in the market, right, for a lot of different reasons. A lot of it's because of tariffs, right? But because of the volatility in the market, we thought it would be appropriate to do a bit of an update and a Q&A and give you an opportunity certainly to participate and to hear what we have to say, what the experts have to say about finding yourself in a correction, regardless of the reason. This time it might be because of tariffs, but there are more corrections to come. Certainly a lot in the past that we've been through. And I think one of the things that's really critical during a time like this is to maintain perspective. And so we're going to go through some material here at the beginning that gives you some visuals and things that kind of look back into history and look at other time periods that were a little bit rough. So we're going to go ahead and hit a couple of items here and share some slides.
Absolutely.
All right. Glad you're here, by the way. Thanks for tuning in today. So as far as where we are in the market right now, certainly a correction, just to define what a correction is, right? I mean, these terms get thrown around, this jargon gets thrown around by the media. What a market correction is, which could be a correction in anything, right? It could be a correction in the bond market, in the stock market, in the real estate market, in the cryptocurrency market, right? I mean, lots of different areas that there could be a correction in, but generally that is defined as a 10% or more drop in the market. Not fun, obviously. A bear market, and the good news is that corrections, and knock on wood, corrections 80% of the time don't turn into bear markets. So a bear market is a 20% or more drop in the stock market, cryptocurrency market. Again, whatever market you're watching, typically a bear market is a 20% more or more drop. And sometimes even those turn into severe bear markets, right, where you're down 30%, 50%. We saw markets like that, and we'll be going through some perspective here on some history, right? Some of them we remember, like back in COVID, how could you not, right? Remember the pandemic and how far the market dropped in a very short amount of time. Also the financial crisis. If you've ever watched the movie The Big Short, or if you remember it, right, in 2008, fall of 2008 was a scary time, certainly for the market, but the entire financial system was in question back at that time. So it kind of looked like there was no hope, but on the other side of it, there was, right? Things did bottom out. And, every correction has been followed by an upswing in the long run, right? So we'll be going through some of those numbers today.
Absolutely.
So looking back to 1926, this one's 1970. Although you'll find that a lot of these numbers rhyme with each other. The market's averaged about 10.8%. Since 1970, but if you go back to the 20s, I think it's like 10.4%, right? So it doesn't change a whole lot. You look at decades and decades of market history in the stock market, the bond market, the real estate market. A lot of the kind of world events and things tend to even themselves out over time. And so the average rate of return, despite all the bad stuff, and you'll see on the slide here, for those of you who are watching the the live version of it or the YouTube version of it. There are a lot of bad things that happened over the last 50 years or so. But there's a lot of good stuff that happened too, right? And so the market drops when there's a lot of uncertainty, and that's what we're seeing right now.
Mhm.
The market hates uncertainty, and so that's why you're seeing the sell off on certain days, at least that we saw last week, and we saw some big down days. Market does not like uncertainty. Market clearly does not like tariffs, right? At least in the short run. So that's what we're seeing as far as market activity. But nonetheless, though, when you look at the markets, and if you invested, say, $10,000, if you had $10,000, or if you were even born right then back in 1970, today, if you just kind of threw it in the S&P 500 and never did anything, you just let it sit. You never took money in, never put, either way, deposits or withdrawals, you'd end up with $2.8 million at the end. So that was despite 9/11, despite the pandemic, despite the financial crisis, despite Black Monday back in 1987, where the market dropped 20% in one day, despite how many wars have we had since then, how many shock events have we had since then, and still your $10,000 would have turned into $2.8 million over that period of time.
Absolutely. And that chart's pretty littered with events, right? And
Sure
so,
is.
yeah, no shortage of those. Now, obviously, there would have been a lot of times that was very uncomfortable,
Mhm.
right? Kind of like now. But yeah, just kind of a real good statistic, I think, as far as staying in the market, even
Yeah.
if it doesn't feel good.
Yeah, and really, that's not because we know what's going to happen, right? By any
Mhm.
means. But we also know that during other bad markets, for people who stayed the course, as much as you may not want to hear that right now, right? It
Right.
doesn't really feel good, right? Say if your pilot comes on, you're experiencing extreme turbulence, and the turbulence keeps going, right? He can say whatever he wants to, or she can say whatever she wants to, but it still doesn't feel good, right? So let's just acknowledge that we don't like it either, but we're there. That's the environment we're
Exactly.
in right now. So staying the course, the reason why staying the course makes sense is, again, not because we know how to time the market, neither do you, right? And neither does anybody else. So that should make you feel a little bit better, right? That it's not that there's somebody else out there, right? That just magically knows how to get in and out of the market over time, or knows when something's going to happen. Even if you predicted this one, right? That there was going to be a big correction here in the spring. Could you have predicted 9/11? Could you have predicted the pandemic? Could you have predicted that after the pandemic and losing 33% in the S&P 500 in the span of what, 3 weeks? It was
Yeah, like
ugly,
a
but
month.
ugly. Yeah, it
Absolutely.
was very short, that we would have ended up being positive for the year. So staying the course, kind of looking back to 2020, use that as the example. That was the last really severe drawdown we had in the market. So you would have been down 33, 34% at the worst that year, again, within a very short amount of time, within a month or so. But had you stayed invested from January 1st to December 31st of that year, you would have been up 16%, as scary as that bear market was that happened in the spring. The other one that a lot of people probably won't remember is in 2022. In fact, I would be shocked if any of you remember that was actually the last bear market that we experienced was in 2022. And even if you remember it, my guess is you can't tell me why. You probably can't tell me the world events that were happening. Silicon Valley Bank. There was some risk of a financial crisis, right, reemerging at that time. The war in Ukraine had just started up at that time. There were a lot of other things economically, interest rate increases, inflation. So there were a lot of kind of bad things that were kind of happening at the time. That year, you actually would have been down. So the worst of it was down 25%. You would have been down 19 from January 1st to December 31st. But had you stayed the course, 2023, 2024, you would have made 24% in 2023. You would have made 23% in 2024. And that's just, again, looking at the S&P 500. We don't recommend that people just invest in the S&P 500. We recommend that you take a much more broadly diversified approach. The whole point, though, is that even after you hit bad markets, it doesn't mean that things are going to stay that way or get even worse. And they might. I mean, there's some time periods like the financial crisis. I remember vividly, and a lot of you do too, right? That not only was the market going down, but it kept going down and kept going down. It took about 18 months until the bottom was actually hit, from October of 2007 to finally in March of 2009, we hit the very bottom of that market. And then, the rest is history, right? Things kind of came back, and people would have done fine the rest of that next decade.
Yeah, I don't know about you, but I have this conversation with clients all the time is, on average, corrections happen about once a year, right? So 10% down once a year. I think this chart definitely goes to show that. But most of the time, like we were saying, about 80% of the time, those corrections don't lead to bear markets, right? And a lot of time, yes, they feel terrible while you're going through them, but then a year or two down the road, you kind of forget that it ever actually happened,
Yeah,
right?
yeah, absolutely. And the average correction over back since 1980 was about 14%, right? Which ironically, that's about, knock on wood, that's about where the S&P 500 is right now. Our correction that we find ourselves in is down 14%. So again, doesn't feel good, but this is kind of an average correction. Doesn't mean it won't get worse, right? I mean, there is going to be a bottom at some point, but just recognize that this is not out of the ordinary, even though the details may be. The details are always different, right? As far as why a correction happens, what's creating the uncertainty in the economy of the world. But that doesn't mean that that it's unique in the sense that they do happen, and they happen about once every 18 months or so.
Absolutely.
So over the long run, we have charts like this. Sometimes you've seen a physical chart, a big cardboard chart in our
Right.
office. And it's easy to look at something like this and think, well, that's great. Why wouldn't you put all your money in stock? So the stock chart shows an average rate of return of 10%, and that's looking back to 2007 in this case. Again, those numbers kind of rhyme with each other, right? You go back to the last 30 years, go back to the last 60 years, the last 100 years, average rate of return of the stock market, evidenced by the S&P 500, will be about 10% a year. So nothing guaranteed about that by any means. You would have been through a lot of corrections, a lot of bear markets to get to that point. Average rate of return on gold, 8.5%, which might seem right now, I think, because gold has gone up a bunch in the last couple of years. Some people are thinking, well, maybe we should put all of our money in gold. But the reality is gold, or putting all of your money in one category, is not a great idea. And gold has a lot higher volatility than the stock market over time. Gold has experienced long periods of time where it's done very poorly. So it doesn't mean don't invest in gold. A lot of our client portfolios have gold as part of the portfolio, but I'm just part of an asset allocation, not sticking all the money in one area. And then everything else, 10-year treasury, home prices about 4% on average over time, which a lot of people say, well, my home has been my best investment. Well, your home on average, unless you got really
Right.
lucky, right, with timing, average price increase on the house has been about 4%. The average annual return since 2007 on cash, only 1.3%. Oil actually negative. You might think that's good, right? If you're trying to go out and buy gas, but you look at all these numbers and you look at longer periods of time, you do see the perspective kind of come back into it, instead of just looking at what's happening right now. Whole point though is for somebody who puts all their money in one category, probably not a great idea. And over the long run, the stock market actually has been the most reliable, in the real estate market too. We don't have real estate up here as far as investment real estate. Many people have built their wealth that way, clearly, right? And doing it in a diversified way, having a whole portfolio of rental houses across the country, if you can afford to do that, right? That would be, a fairly diversified portfolio in real estate. So
And
that
over
perspective.
time, stocks and real estate typically end up right about the same.
Got the same spot. Just to be clear though, again, home prices alone, like the house that I own, one that Jeremy owns, uh, your house on average would have gone up 4%. Mine would, because we don't have any rental income.
Yep.
Now, if you're renting out the basement, right, you're renting out a bunch of rooms and maybe you just occupy a room in the house. That's probably not what most of us are going to do. Now that could actually be a pretty good investment, right? Because of the income portion of it.
Yeah, absolutely.
All right. Bull and bear markets. So a bull market again is basically after a bear market. There's never been a time when there's been a bear market that wasn't followed by a bull market. And really the bulls end up winning over time simply because the bull markets go up more than the bear markets lose. Even in extreme time periods like the bear market we had in 2008, where the market was down by about half. Uh, it would have been pretty tough, right? And it was pretty tough, right? Because I guided a lot of people through it at the time. But on the other end of that, though, when things finally burned out, when the fire burned out, then we saw a bull market of 400% increase. It happened over about a 10-year time frame, but about a 400% increase from, again, the end in 2009, the bottom of the market, up to 2020. Actually, it was the pandemic that was kind of the trigger of what caused another bear market. About a year, basically that bear market lasted during COVID, and then we saw a big increase. And then 2022, we saw another bear market followed by a couple of years of increase. So this is just the story of the market over a long period of time that kind of surpasses politics. It kind of surpasses who was president and what all the details of it were. We know that those things are going to change over time and be dynamic, but looking at history, the most successful investors, which is what we're trying to do, right? Be successful investors over long periods of time have been people that have kind of stayed the course and not made huge moves or huge timing decisions during that period of time.
Also because it's really hard to make those decisions, right?
It is, yeah. I mean, because you've got to get two right decisions, right? Not only
Mhm.
I got out at the right time, but let's say that you were super lucky. Let's say that you were just the luckiest person in the world and you cashed out all your investments in say February of this year. That's when I think the market hit its peak. So maybe you were super lucky. So when do you get back in if you're sitting in cash right now?
Mhm.
Looking at a lot of these numbers, you find that almost always you end up seeing increases, right, within a fairly short amount of time.
Yeah, which kind of leads us to this is that yes, it's in theory, yeah, it'd be great to be able to get out and go to cash at the right time and then buy in at the bottom, right? But the timing of that is near impossible, right? I think even Warren Buffett says he's never met someone who can do it,
That's absolutely
you
right.
know.
Yeah,
Uh,
famous quote. Yeah.
Absolutely. So the thing on this is even just this is again saying about 10,000 invested in the S&P, so starting end of 79 and through today. And so really what we see here is even just missing kind of the best 5 days in the market. You would have missed out on quite a big opportunity right there. Fact of the matter is that the best 5 days typically happen within the first 2 weeks of the market reaching the bottom.
After the bottom.
And that is next to impossible to time, right?
Yeah, because you
Is
don't know where
they,
the bottom is until well after the fact,
yeah.
right? I mean, we didn't know. It's easy to say now in the pandemic, for example, we were down 33% in like again a month or so, but
Mhm.
there were a lot of predictions that things were going to get way worse.
Oh,
Right. I mean, way
absolutely.
worse. Like, I mean, that, hey, we're going down 50%, 60%, and we're going into a depression. That was the prediction at the time, actually, is that this is probably going to be like the Great Depression. It could be an entire decade of terrible economy and market and so forth. Uh, but if that was what you made your bet off of, in other
Mhm.
words, even if you did get out at the time, you would have missed out on all the growth that happened, and you would have been missing out on the opportunity to be up 16% by the end of the year. So even in an extreme
Absolutely.
situation like that, the trick is again is it's hard when you're in the middle of it, right?
Yeah.
Like a really turbulent flight again. It's hard. I mean, when you're sitting there and you're nauseous and the plane's going all over the place and it doesn't matter, at that point, nobody can kind of rationalize it away, right? Because you don't know, right, when it's going to be over.
Yeah, absolutely. Yeah, absolutely. And so, yeah, that's the toughest thing is that you run the risk of, right? And so really the best idea, and I know it doesn't feel super comfortable, right? We hear this all the time, but truly one of the best things you can do is just stay in the market, stay diversified. It comes back, right? If
Yeah,
history tells us anything,
yeah,
it's just a matter of time. The tough part is we don't know how long that's going to be, right? And so yes, there are things that we can do to plan accordingly for the worst, but the staying inside of it is really ultimately going to be what the disciplined investor does.
yeah, absolutely. Yeah, and I think that is what it comes down to too, is just being disciplined and not letting emotions shake us. It can be very tempting to do that.
Hmm.
And the average investor, and Fidelity's done studies on this. It's one of our partners, right? Fidelity, that we have a lot of our client money is deposited there. Well, Fidelity, they're pretty smart, right? They know how to pull reports, right? They actually know the average rate of return in people's accounts.
Hmm.
And they've actually found that the more often that you log into your account, that the worse your rate of return is. So I'm going to say that again. The more often that you log into your account, I bet if we went to Schwab or Merrill Lynch or anybody else, they would find the same thing. The more often somebody logs into their account, the worse your rate of return. So why would that be? Because the more often
Emotional
somebody
decision.
logs in, yeah, the more you feel like I got to do something, right? And that something, whatever that was, probably wasn't very smart. Now that something 6 months ago wasn't being scared. What it probably was for a lot of folks is being greedy. Could have been that, well, I'm going to buy a bunch of Nvidia or I'm going to buy a bunch of Bitcoin or whatever it is that was kind of the hot investment of the day.
Hmm.
So that's something, in other words, doesn't always have to be because of a bear market. Could be because of a bull market, but it's letting emotions drive the decisions and get away from a well thought out, diversified plan that's built for the long run. a lot of times when people log in, they do worse things, right? Fidelity, the other funny one, kind of funny, right, is Fidelity knows that the best category of investor, that person or the category of investor that does the best as far as rate of return is actually dead people, believe it or not.
Yep.
Why? Because they can't log in.
Right.
Right, and they're not going in there and messing with stuff, right? And
Yeah.
trading, so their
Not
rate of
placing
return
trades.
actually ends up being the best. So that doesn't mean that you shouldn't do something different, right? It's your money ultimately. So we've all got to make our own decisions with that. But it is something to at least ponder, right? If those numbers are true, that there's probably something to think about.
Which is also where, not a self plug or anything, but where a good financial planner can help you out is by kind of taking some of that emotion out of it and reminding you, that we do have a plan, and that the plan is still a good plan, right?
Yep, absolutely. Positive, negative years. So S&P 500, this goes back to 1926, and you can see average rate of return was up 10.4% over that period of time. Why do we just use the S&P, by the way? It's because it's broadly diversified. It's the one that has the most history, really, right, as far as having good data that goes back that far. But it is not bad, though. I mean, it's 500 of the biggest companies, publicly traded companies, at least in the US. So average rate of return of 10.4%. So of those years, there were more positive years than negative years. Doesn't mean there weren't a lot of negative ones. Of those years, over 99 years, 73 of them were up, 26 of them were down.
Mm-hmm.
And so to get that 10.4% rate of return, you would have had to suffer, right? And it is,
Right.
just to acknowledge it, it does not feel good to any of us, right? To see asset values drop. But that's the only way you would have gotten that return, would have been suffering through those down years. The good news, again, is there were more up years than down years, and the up years were more up, right? The average rate of return for those 73 that were positive were 21.5%. And the average down year was, again, kind of funny based on where we are right now. Average negative year was down 13.4%. And again, not calling a market bottom here, but we're sitting at about a negative 14% for the S&P 500 right now, which is just about the average of those negative down years. If this even ends up being a negative year, our case is still not that we're going to see necessarily a down year. There's very likely going to be the case that there's a bounce back here at some point, even though we might have some further down to go before things bottom out. Again, the market hates uncertainty, and there's plenty of it right now.
Absolutely. And so, of course, probability of positive returns here. So really, I think our key indicators on this are really that, 3 and 5 year number, right? It's any 1 year can kind of do its thing, up or down, wild swings and whatnot. But again, maintaining that long-term focus, maintaining the fact that, yes, you have a plan. It's a good plan. The bad years do get factored into the plan, right? Which is why we use some conservative estimates on a lot of this stuff. But that being said, that 3 5 year, when we get up into those kind of 90% of probability of positive returns, it's a pretty nice thing.
Yeah, figuring the odds, in other words, which the odds don't really tell you anything about what's happening at any given moment, right? But for a given day, it's a coin flip on any given day. Basically, the
About a
data shows
50-50.
about a 50-50 chance that you'll be up or down today, right? So
Yep.
not great odds, in other words, for a day trader, right? So most day traders don't do well, in other words,
Yep.
because again, their odds aren't good. But a month, 62% chance that you'd be positive in any given month. A year, up 77.4%. So not guaranteed by any means, right? None of these numbers are, but over a 3 year period, 87% chance you'll be up. 5 year period, 93% chance that you'll be up. And over a 10 year period, 97.4% chance that you'll be up. I think there's only been like once or twice ever, in any 10 year period that somebody would have been negative. So maybe this will be the exception to the case, right? But probably not. Most of the time, your time in the market makes the biggest difference.
Absolutely.
Volatility. Volatility defined as a 1% or more jump or drop, right? Because volatility works both ways, right? And we've certainly seen it the last week or so, the last couple of weeks or so, is the volatility works both ways, a 1% jump or a 1% drop in the market. The average year, looking at the last, say, 20 years or so, the average year, there's about a 65 day average as far as a 1% up or down in any given day. So in other words, if it feels like there's more volatility right now, we'll see by the end of the year. We've had 21 days so far, at least through the end of the quarter.
Mhm.
As far as that 1% or more jump or drop, but 65 days on average out of 365, that means that, volatility is a normal thing and a normal experience as an investor. There are certain years like 122 days that we had in 2022 where we saw an up or a down more than 1%. In some years like 2017, there were only 8 days, which was weird, right?
Mhm.
That there were only 8 days. Basically, the market just didn't move a whole lot, right? It was very steady that year. Don't you wish that things were always like that? That's pretty rare.
Absolutely.
Yeah.
Yeah, and a lot of the high ones are definitely associated with, you know, turbulent times
Yeah.
or down markets. So 2020 as well, saw a bunch of that as in there as well. 2015 was another big one. I don't know if anybody remembers, but 2015 was a down year in the market.
Yeah.
So yeah, kind of coincides.
My guess is that most people, including me, actually, I can't even remember why we were down in
I,
2015.
I don't
Most of
either.
these are forgettable. Again, it's kind of like turbulence for those of you flying, right? Most of every flight, 100% of the flights I've been on, there's been turbulence at some point,
Mhm.
right? I don't
Absolutely.
think there's never been a flight. Do I remember most of them? No. There's a few I did. Just because it was so bad, right? You
Mhm.
can kind of, oh, okay, yeah, this was happening, but the plane still landed, right? But it still wasn't fun. So
Yep.
most of these are pretty forgettable. This one might be too, right? It could be that this blows over, maybe not. It might very well be one that,
Yeah.
oh yeah, man, the 2025, the tariffs, and we might look back at this year as being a really rough year, or not.
Yep. Time will tell.
Yeah. S&P 500 performance after its worst days. So looking at the 15 worst, and again, the year's not over. Maybe this year will have one of these, right? But looking at the 15 worst days of the last 30 years or so, the worst day, many of you might remember this, that was Black Monday
Mhm.
back in October of 2000, or not 2000, but October of 1987, right? Market was down 20% in one day.
Yep.
Yeah, that was extreme, right? And yeah, well, at the time, so I didn't
Right.
know, right? But back in 1987, it was pretty bloody. But even in that, even the worst day that we've ever had in the stock market, down 20%. A year later, up 23%. Somebody would have been up 23%. But we'll look at some other extremes. We'll look at 2020, right during the
Mhm.
pandemic. We had a couple of days where we were down 12% one day, 10% one day. Um, Up 66% a year later, up 59% a year later. In fact, of the 15 worst days that we've had over the last few decades, there's only been one time that you actually would have been down. In other
All
words, you
right.
would have been negative over the next 12 months, and that was back in the financial crisis. And then you would have only been down 4% a year later. In the other cases, though, on average, it was 30%. In other words, of all those drops, of
Mhm.
all those worst days, on average, a year later, you would have been up 30%. So again, it doesn't guarantee that anything, right? It doesn't mean that this will be, not different, right? And that we could be negative a year from right now. But on average, though, that's what we're really looking at is how to be a successful investor, right? What are the odds? What are time tested principles that I can follow?
Absolutely.
All right. And then, last point here, the S&P 500 and the Dow, looking back to 1942. And this is just, again, where good data is available. Corrections about every 16 months, 16 to 17 months, that there's a correction, like a 10% or more drop. A 15% or more drop happens about every 3 years historically. And then 20% or more, which again is a bear market, about every 5.5 years or so, is when those come along
Mhm.
on average. Doesn't mean you won't have a couple of them back to back, right? Like we saw in 2020 and 2022, those were pretty close together. But historically, that's how often these do come around. So as unique as this might seem, in other words, and as uncomfortable as it is for sure that we're seeing the market gyrate like we have, it's certainly not unique, at least from a historical perspective.
Yeah, absolutely.
All right.
So that pretty much sums up our slides here. Now I think
Yeah.
it's time for some
Let's do some
questions,
questions and
right?
answers. Yeah. So, and one thing I was going to mention too, we went through those kind of quickly, and for the benefit of those that are just listening to this on the podcast as well, know that these are available. We'll make these available on the website, and we'll also make these available if you just email us at communications@keystonefinancial.com. We'd be happy to send you these slides.
Hmm.
Would be happy to jump on a call with you too if you want to unpack it, in other words, and maybe better understand where the data is coming from.
Yeah,
So
absolutely.
let's do questions. That was the main point of today, but we wanted to put some perspective on this because when you're in the middle of a storm or an earthquake or whatever metaphor you want to use, it's easy to lose perspective, very
Hmm.
quickly, right? And get too focused in on the news of the day. And of course, the news, that's their job, right? Is to get us to click, to get our eyeballs, and so forth. It's funny how many clients we've talked to this week that they're like, yeah, I'm not looking at it. Yeah, I'm turning off the news. I
Right.
know, things are crazy. So on average, that's what most of our clients have been telling us, which is the right thing to do,
Hmm.
really, because you can't really control it,
Yeah,
right?
and there's not much point in driving yourself crazy.
Right.
Right.
Exactly. Yeah, and you certainly don't want to be that victim, right, of the fidelity study of logging into your account every 10 minutes, right? And now all of a sudden, your odds of starting to do something rash continue to go up.
Absolutely.
So let's hit some questions from
Yeah,
clients.
so some of the pre today questions, we had a couple of them. So what we did is we consolidated a lot of these. So might not hear your specific question, but I think we'll get everything covered here. So we did have a question specifically on bonds or kind of less vulnerable instruments.
Mhm.
Is it a good time to go into those? What benefits do they give you? What's the cost associated with them?
Yeah. And bonds, or sometimes called fixed income, is the jargon, right? We use in our industry, just maybe a fancier word for bonds. Bonds are a guaranteed investment, but it depends on a lot of things, right? I mean, that guarantee is just as good as who's doing the guaranteeing, right? Is it a federal government bond? Is it a corporate
Hmm.
bond that's guaranteed by Microsoft or something like that? Then it's just as good as who it is that's issuing that bond. And also keeping in mind that bond has a maturity, and that maturity could be 20 years out, 30 years out, depending on what kind of a bond that you own. And know that price can fluctuate because your promise of the money back doesn't come until 10 years, 20 years, 30 years, whenever the bond matures. So recognize that even the bond market can see swings, and even the bond market can see negative years. Even though those guarantees are still there, right, on the underlying
Hmm.
securities, that doesn't mean that the prices won't change in the meantime. Historically, the rate of return on bonds is a heck of a lot lower. We saw that chart before than stocks. And so it could be that it's probably part of your diversified portfolio, especially if you're retired. Almost certainly that's part of your
Yep.
portfolio is having some fixed income. But recognize that the more fixed income that we put into a portfolio, over time, at least, unless history completely upends itself, right? The rate of return that you're going to be getting is lower, which means the end result is lower. You don't have as much money to spend. So keep that in mind. Doesn't mean you shouldn't make an adjustment to your risk number or your profile, but just recognize that there's a price to pay for that too.
Absolutely. And I was going to say that
Yeah.
too, is that, depending on what your risk level is right now, typically bonds or bond funds of some kind are a part of your portfolio, right? And so it's not like we don't, you probably already own some, to tell you the truth, at this point, and that's kind of the ballast to the ship a
Yeah,
lot
and
of time.
there's no guarantee in 2022 that even diversified investors, the bond market went down and the stock market went down. They both
Mhm.
went down that year, again because the Fed was raising interest rates aggressively, and it caused bond prices to go down temporarily, at least. Right, there was some bounce back in future years, but being a really diversified investor, unfortunately, didn't help a whole lot
Yeah.
in 2022. It was just a tough year to be
Yep.
an investor in anything.
Absolutely. Next question that we have is, typically told to not overreact to short-term fluctuations. What is the trigger point to a major change?
Yeah, major change. Again, I mean, the data does not, all the stuff we just looked at doesn't support a major change as far as timing. That as if we could time things in and out, or that you could either, or anybody, right? Even the biggest institutions like Fidelity, Schwab, BlackRock, think of the biggest money managers in the world. They'll acknowledge as well that they also do not know how to time the market. Now, adjustments to a portfolio or making sure you're well diversified, not over concentrated in certain areas. Absolutely. But if something fundamentally has changed in your life, that's usually the trigger as far as why we would make a huge move. In other words, let's say that
Mhm.
your risk number, which you use risk numbers with clients. Let's say your risk number has always been a 70, and you've been very comfortable. You got through the pandemic in 2022 and all kinds of markets, but you're wondering, gosh, maybe something's changed here. Maybe your overall temperament's changed. Maybe your overall situation or even time frame has changed. Or maybe there's a chunk of money, maybe, you weren't planning on it, but hey, I need $50,000 now that I wasn't thinking I was gonna need, but I need it in 3 months. Yeah, you might want to think about that, right? Based on the
Mhm.
the data we saw before, the odds aren't exactly good, that things will be up in any 3 month period of time. So certainly things can get worse. We're under no illusion that we've hit a market bottom, although we're a lot lower to the bottom than we were, right? I mean, the market
Mhm.
was a lot higher, right, from a valuation standpoint. It's looking a lot more attractive right now than it was, but it doesn't mean that there won't be further downs or surprises or hits to earnings or economic growth based off of the tariffs.
Absolutely.
So a lot of it's just your life, if your life circumstances have changed. And if it's extreme anxiety, maybe even after all the perspective and time, I know I have 20 years and all that stuff. If you're losing sleep at night, it's probably something to at least talk to us about, right?
Mhm.
If maybe you just can't take it anymore. In other words, doesn't mean that it won't be a bad investment decision to make a change, right? But if that helps you sleep at night, you may have to do it.
Absolutely. Absolutely. So next one, it's hard to know, of course, if tariff trade war is a game of chicken or a long-term strategy. How do we ride this out without preparing for a recession?
Well, I think if you hear most economists think we're already in one
Hmm.
at this point. In fact, it would be surprising if we're not. In the near term, whatever you think about tariffs, I'm sure you don't like them, at least from your portfolio standpoint right now. But tariffs, they're certainly likely to cause inflation. They're certainly going to have a massive impact on trade policy. So it's very disruptive, and that's why the market doesn't like it. So we're probably already there. In other words, at this point, it's just a matter of it. Is it a mild recession? Is it going to be a really bad recession? How long is it going to last? And that's unknowable right now. As far as it being a game of chicken or a long-term strategy, I think it's both. It's in the near term, it's
Yeah,
both
there's
for
definitely
sure.
some posturing going
Yeah, if
on.
you see the news every day, I mean, it's clearly a game of chicken, but it's also this isn't just going away. I mean, clearly
Mhm.
that's what people were thinking. Maybe it's a game of chicken back in January, February. It's very clear that the administration is very committed, to
Mhm.
to a longer term strategy of tariffs. So not not something that's going away. How to prepare for it? Again, revisiting your plan, revisiting your time frame. Certainly, we'll be making adjustments along the way as far as rebalancing, but no matter how bad it gets, in other words, there's still always a right and a wrong way to react to it. And again, market timing or making a huge move probably would not be in your best interest.
Yeah, and I'll just follow up by
Yeah,
saying,
yeah,
again, for any of our clients that work with us, we've been working for years, depending on how long you've been with us, to develop a plan, right? And that long-term plan, we're not going to necessarily throw the baby out with the bathwater, right? And the reason why we trust in that plan is because we have a solid process that we follow,
that's a good
time
point.
tested, that we're doing for all of this. And so behind the scenes, obviously we're doing a lot of rebalancing, right? There are pockets of opportunity that pop up in times like this, and
Yeah.
we get to take advantage of those when they come along. And it's not usually something really flashy or major. It's small shifts between sectors here and there, which kind of leads us into our next kind of two questions.
Sure.
But really, with everything happening right now, trade war, inflation concerns, decreasing government subsidies, et cetera. Are there any sectors we should be avoiding or buying? And how does Keystone kind of protect our portfolio as we're
Yeah,
doing this?
absolutely. And a lot we talked about this in our forecast too, is that, there was a concern at the time, which ended up being, we didn't know why, right? I mean, necessarily, but the Mag 7, which are, uh, seven companies, right? Seven
Mhm.
big tech companies that had been getting a lot of the return, out of the market the last few years, that they were probably overvalued. Now we really know they were overvalued, right? Because those have taken a huge hit. In other words, if your
Mhm.
portfolio was over concentrated, which it would not have been, by the way, if it was with us, we would not have loaded you up on sticking all your money in Apple or Google or something like that. But yeah, those are a lot more extreme as far as losses. Doesn't mean those companies are going away. It's just that they were overvalued at the time. So not over concentrating, not making a big bet right now. So staying broadly diversified, even though that seems really boring, right? And maybe it should be really obvious, right? That you go to a certain sector or rotate around. It's true we do steer the ship. I mean, there are some tilts, that we'll make, but clearly in the near term, the market does not like tech stocks because they were overvalued before. But as we rebalance, I mean, that's part of the benefit of doing that, though, is that when you get one sector that's kind of becoming an outsized part of a portfolio, continuing to rebalance, will gradually trim that money off, right? And put it into other sectors. Same thing though on the opposite though, if you see tech stocks drop a lot, say 30, 40, 50%, certainly we saw that back in the dot-com crash in the early 2000s, continuing to rebalance, though you're actually buying those things though, hopefully at a lot cheaper price. And so, people that are rebalancing tend to get better rates of return over time than people who just have a static portfolio, or even an overly concentrated one area.
Absolutely. Yep. So again, kind of this kind of goes back to maybe the bonds question, but what are the available options or strategies to protect portfolio value or take advantage of things in the market for more stable returns?
Yeah, again, I mean, the categories that people would, a diversified portfolio and having a strategy, right? I think that's going to be key is not to get tactical about this. It's very important to have a risk number that you can live with depending on, no matter what the market's doing, in other words, because that's kind of what you're selecting, knowing that there are going to be good markets, bad markets. And so you might be a 50 out of 100, you might be a 70, you might be an 80, you might be a 10, or you might be a 0, which means you probably just have all your money sitting in cash in the bank. And that might be the best option for you, right? If you're not willing to take any investment risk or have any uncertainty. So I think it's really important just to know, what a bad year looks like. And that's why we spend a lot of time with folks up front, right? Kind of understanding not only what rate of return potential does this portfolio have, say at a 70 or 60 or 50 or 40, what historically, what would that have generated in rate of return over time? But also, what does a bad year look like? Even a conservative portfolio, say if it was a 30 or a 40, those can even have bad years like 2022.
Absolutely.
Yeah, it actually wouldn't have helped you one bit, right, to have bonds. If bonds and stocks went down about the same amount that year. So really the only investment, if you want something that's 100% protected, and then, you can even debate that, then it's subject to inflation risk, right? Or putting too much in one bank and you lose money because the bank goes broke or something like that. There's always risks, right? It's just a matter of what risks are you willing to accept. But, keeping a higher level of cash, that might be appropriate. We always recommend at least 3 to 6 months worth of living expenses, sometimes 12, depending on your situation. And maybe that's how you deal with them, for somebody who normally is just fine, right? As far as maybe, hey, I'm still a 70 risk score or 60 risk score, nothing fundamentally has changed. But if somebody feels like, hey, I feel like I need to make some kind of a move here, just to sleep at night, that might be what they do. Is normally they keep 9 months worth of living expenses in savings checking. Maybe they bump that up to 12 for right now, because this could be short-lived, but I wouldn't count on that by any means. It could be, a longer thing, right? It could be a longer negotiation and back and forth and volatility on and off, up and down. This could last a while. So, whatever you need to do, and we'll certainly talk you through it, right? But
I was just going to say that.
maybe it is you're raising cash, raising the number of months worth of living expenses kind of buys you that time, but allows you to still stay in the game, right? And not be subject to the risk of kind of making a bad move, right? Where you end up being out when the market eventually bounces back upward.
Absolutely. Yeah. So it's really all about that risk score and just kind of your tolerance, but kind of go into what you said, if there is a specific thing, and obviously we do things like this and take phone calls all the time and, for lack of a better term, talking people off the ledge, right?
Yeah.
But that's
we haven't had to do that.
no, we really
Just to be
haven't.
clear, we haven't.
Yeah.
I don't think we've had a single call from somebody that's panicking. I didn't have a single email in my inbox on Monday morning of this week, even though we had a couple of really bad days last week. Not a single email from a client saying, so, hats off to all of you, right? I mean, you're probably not enjoying this, right? But you're keeping a level head about it.
Absolutely. Absolutely. But that's kind of the role that a good financial planner can also serve, right? Is being that voice of reason, but also, if you do have a genuine concern, talking through it and saying, hey, I know we have a plan, but maybe it's time to adjust the plan. What does that look like? And that's where we can kind of fill in. Is say, yeah, well, what are your needs? How much cash do you need to get you through the next year? How do we come up with that so that the rest of this stuff can make a comeback?
Yeah.
All right.
Yeah, for sure.
Yeah, absolutely. So here's another good one. So what metric would you use for a client to determine whether they're at real risk of a severe financial stress problem, right? Whether that's kind of pre-post tax account split, investment splits. How can we establish, what point do we make a major decision in investment mix until waiting until it's too late, where it's 20, 30, 40, 50% down drop in equities?
Right. Yeah, a couple of things there. Number one, it sounds like part of it could be a question about just personal circumstances as far as when somebody needs the money. And sometimes that changes. For example, somebody might have had a certain spending level, and now all of a sudden somebody's health has failed, and it looks like, now we're going to have to pay for long-term care. And where we were taking a fairly modest withdrawal each month, now that's going to go up a whole bunch. So instead of a 5-year, 10-year, 20-year time frame. Now we've got a 3-year time frame, or maybe it's all going to be used up in 5 years. Well, that's that looks a lot uglier, certainly, because getting, as we saw in all the data before, uh, so it's so important to control your withdrawal rate, because really the only people that get hurt during bear markets are the people that are forced to sell, right? Because you're being forced to sell at low prices. And again, if this market turns a lot lower, that problem gets more severe. But that's where we recommend, as an industry, we recommend a 4 to 5% withdrawal rate, just because it means that we're just selling small pieces out of the portfolio. Now, if we see a pullback in the market, say things are down, like a financial crisis, maybe things go down 50%, which we don't think is going to happen, but doesn't mean it won't happen. Down 50%. Now, all of a sudden, that looks a lot uglier, right? As far as somebody who might have been taking out 3%, 4%, 5% each year, now that number is just kind of blown into the stratosphere, meaning that they're doing a lot of forced selling, right? So it's prudent. I mean, certainly we've had a lot of clients already that have even told us that, hey, we're pulling back on spending for right now until this settles out. We were going to get a new car, but now we're not. We want to reduce the amount that we're taking out of our investments, or even in some circumstances, that hey, stop my withdrawals. We've got a bunch of money in the bank, and so we're going to live off of that for a while. So yeah. I mean, it could be very much related to that, but I think it goes back to the risk number again, is looking at what does a really bad year look like, and can I live with that
Absolutely.
as an investor, and knowing in an all stock portfolio, we saw that before, right? With the S&P 500 in 100% stock portfolio, there have been times, there have been several times, over the last 100 years or so, where the market went down a lot very quickly, down 30% to 50%. So again, for a 100% stock portfolio, that might be like a 75-80 risk score on a scale of 1 to 100. Most people, especially if they're retired, most people are probably not going to be comfortable with that, right? And so we started introducing fixed income and other stuff that brings that risk number down. But again, it kind of goes back to that, is what does a really bad year look like, or what has it looked like historically?
Absolutely. Yeah, and to kind of put that into account too. So obviously, if you've worked with us anytime, from either Josh or myself, you've heard that 4% rule, right? So what does that mean in periods like now, right? So just to kind of give you some round numbers to think about that, let's just use some round numbers. Your portfolio is $1 million. 4% distribution on that is $40,000 a year, or roughly about $3,300 a month, right? 20% drop in the market. Now your $1 million portfolio is actually worth about 800,000. That also means though that 4% is no longer 40,000, it's actually 32,000, which drops that monthly from 3,300 to about 2,700, roughly, right? 30% drop, same thing. Instead of $1 million portfolio, now you have a $700,000 portfolio. Now we're 28,000 as opposed to 40 per year, or about 2,300 per month. So really, I think especially for retired individuals who are kind of living on this portfolio now, that is something to definitely consider, is if we want to try our best to stay within that 4% rule. Yes, it might make sense to kind of pull back on what you are pulling out, because you might have started out that, hey, we're pulling 4%, but now you're pulling 6%, right? Or 7%. So these are definitely things to be considering as far as, well, how do we weather this storm? What if it gets worse? What are the things that we can actively do right now? That's a big one.
Yeah, absolutely. Yeah. So withdrawal rate, and again, that's trade-offs. Obviously, nobody likes it, right? It could be that you've got to put off a major purchase, or home improvements or something like that. It might even be getting really uncomfortable, right? We're all right. We were going out to eat a bunch. We were doing DoorDash a bunch before and spending a bunch. All right, now we're going to do a lot more home cooked meals and things. So, in some circumstances, people make some big changes, just to get their spending down. Now, of course, that it doesn't matter as much if it's short lived, right? If this ends up being kind of a short period of volatility versus does it turn into something much worse and end up with, and maybe it turns into an 18-month deal instead of a couple of months deal.
Mhm.
The duration matters a lot as well.
Yeah,
Yeah,
absolutely. Yeah, and of course, like anything, when we're in this, it feels kind of weird, or feels like, hey, this is something we've never dealt with before,
right.
right? There's always
Yeah,
something new that
which
comes
is
along
always the
that
case. Yeah,
that does
yeah.
this. But we had one client who says, hey, feels like the rules of the market have changed. Usually I'd buy in, buy the dip, et cetera, right, and
Right.
and make good off of that. Is it really, should one's individual risk tolerance, size of the portfolio, spending rate, draw rate, should that really be making all the decisions, driving changes that we're making at this time?
Mhm. Yeah, again, I wouldn't make any rash moves. If you had cash right now, let's say you had some dry powder, good for you, right? If you had like extra even on top of your emergency fund and so how do I get that money invested? Should you do it all at once? It depends. Again, we go back and look at the numbers before. If it's a long-term investment, if you're not going to be touching it for a long time, maybe. I mean, maybe you just go into your strategy and you're fine. It could also be a dollar cost average in, which just means that we do it in chunks, right? In some kind of a disciplined manner. Maybe it goes in over a 3 month period of time or 6 month period of time, which means that if things get worse, in other words, and the market goes a bunch lower, then all right, well, we got some of those average prices as they went down, but it cuts both ways, of course. If you did it over that period of time, the market could have bounced back a bunch too. And so again, unknowable, but that is one way to kind of smooth out that risk.
Absolutely. Here's another good one.
Sure.
What's the risk of stagflation coming to fruition?
Yeah, I think medium to high risk.
Hmm.
I mean, at least who knows how long that would last, but I think it's pretty likely. If you just look at tariffs again, whether you like them or not, I mean, tariffs, they are a tax, clearly, right?
Hmm.
They are a tax. So, that could have an impact on the economy, certainly can have an effect on people's spending, right? Can be inflationary, which means that the Fed may not have as much power to lower interest rates. You could end up with a period where interest rates are going up, which means that, yeah, we'd have stagflation, means that you have high inflation and the economy is not doing so hot. So, yeah, I think at least in the kind of medium term, long term, probably not. But I mean, in the medium term, I think there's actually a fairly significant risk of that. And it's not that the market already doesn't know that, right? I mean, that's why you're seeing things priced in the way
Yeah,
that they,
that's a good point.
so, all the things we're talking about right now, we have no secret information, right? And neither, right? That's why the market's gyrating right now and trying to figure out how do we want to price everything here, right? To take into account what's going to be happening over the next 12, 18, 24 months in the economy. And the reason why the big moves because the market's trying to figure it out, right? And so that's why the gyrations.
Yeah, absolutely.
Yeah. So yeah, I mean, there's no we don't want to sugarcoat it. I mean, I think we could be in a period of not the best of times, at least in the short term.
Absolutely. Yep. Next one up, general question out of curiosity is, do we ever make a move to start drawing monthly funds
Mhm.
from different places, such as bonds versus stocks?
Yeah, absolutely. And so, yeah, question is that let's say we saw a really severe downturn and it lasted for a while. So let's say we go back to the financial crisis. That was the last time that we saw a really big drop and it lasted a long time. I remember, clients, we did do that at the time for people that were retired, in other words, and pulling money out. There were a number of clients that we just stopped selling stocks for their monthly distributions. In other words, we kind of carved off and we had some treasury funds and cash and things like that, and they had a long enough period of time that we were basically drawing down on that until things bounced back, which eventually it did. And then, of course, you go back and rebalance. So that was the last time that we made a big move like that, simply because not only was it a downturn, but it lasted a long time.
Mhm.
Right, it was just kind of an extreme. So it's not something that we want to necessarily do on a immediate level, uh, right? But if it turns into something much more severe, then we may want to look at that. Certainly, we would be doing that on an individual basis for clients. And part of the reason, even though logically it might make sense, well, why wouldn't we do that right now? But look at the financial crisis. Again, things got a lot worse, right, over an 18-month period of time. So, you could have blown through all of somebody's fixed income and cash, in other words, over that period of
Mhm.
time. And then been at the bottom. Now you're forced to sell stocks after the market's down 50%. So because we don't know the
Right.
duration necessarily, disciplined rebalancing along the way continues to keep your risk number in check. But again, if you're in an extreme sell-off, and you're probably close to that. I mean, in the pandemic, right, the market was down 33%. I don't know that we did that with any clients then, but the bounce upwards was fairly quick, right? We saw the market bounce back off of those lows. So we didn't get to that point. If this turns into something much more severe, I'm sure we'll be having those conversations.
Absolutely. So this one we kind of already answered, I think, but should we, with uncertainty in the markets, everything should be withdrawing cash from our banks, as a precaution, kind of a follow-up. Will any of this turmoil cause any issues with, the credit union as not being able to,
Okay, yeah, okay, or
not
yeah.
lose cash, things of that nature?
Yeah, yeah, and some people, of course, it's individual choice. Again, with my last comment about you don't know how long it's going to last. You could blow through all your cash and then see asset prices lower. So I would never go less than 3 to 6 months worth of living expenses in
Hmm.
cash. Always keep at least that in the bank. So I don't know if this is the time to kind of blow through all of that cash right now. We've had some clients that had a lot more. They might have had a year worth of cash, and they say, to turn off my withdrawals.
Hmm.
I want to just pull from cash. We're going to reduce our spending for a few months and we'll see how things shake out. So obviously it's dynamic. We're keeping in touch with them. As far as any financial institution, that funny thing about, well, not funny, but 2022, right? Silicon Valley Bank, and talk about things that nobody remembers, right? Silicon Valley Bank and Signature Bank, and there were other ones at the time. There was at least a huge fear across the economy that there are these banks and they were taking on a lot more risk than what anybody thought. And they had to get bailed out. Some of them did
Hmm.
have to get bailed out. The government stepped in and so forth. So I don't know of any depositors that necessarily lost money, but I think the concern of the question is about how much money should we be keeping in any one bank. Uh, so yeah, the limit is $250,000, I think, on the
FDIC.
FDIC or NCUA if you're at a credit union. You could, I mean, again, I don't know, even in the financial crisis, even if people that had money on deposit at now defunct banks, I don't know of anybody who actually lost money, but
Hmm.
that doesn't mean you couldn't, right? And that was just because the government stepped in essentially and said, all right, yes, the FDIC limits, but we're still going to kind of shore the institution up so depositors don't lose money. But
Yep.
that was a real risk back in 2022, right? Or at least a fear.
Absolutely. Here's one regarding required minimum distributions. So, basically asking about the timing. Is it better to take it now? Should I wait for the market to jump back? How's it calculated? So, quick thing on RMDs.
Sure.
Basically how they calculate a required minimum distribution is they take the 12/31, so December 31 balance of that account, from the prior year, and then plop it into their formula based on your age, and that's how much you have to take out. And then you have the entire year to basically take that out. So timing wise, again, we're not huge fans of trying to time the market or whatnot. The basic rule is just that it has to be out by December of that year,
Right.
pretty much. But I would say that would be more in line with, kind of like we were saying, cash needs. Do you have any big things coming up, big expenses that you can foresee, or not? Obviously we want to have to, we're going to make sure that you satisfy it, right? Because you don't want to have to pay the penalty of it. But there's also not a major rush or push, I don't think.
Yeah, you could do it in chunks too. I mean, there's different ways you can approach
Exactly.
it. But you could say, all right, I'm going to take a third of it right now, and
Hmm.
just wait a few months, take another third. Or if the market comes rocketing back at some point, then I'll take the rest of it. So,
Yeah, kind of
yeah,
dollar cost average
yeah,
out.
exactly. And you know what? Not that they would do it again necessarily, but that one thing I remember now in 2008, market was down extremely, right? I think Congress actually passed a bill that year that exempted, or maybe it was the IRS actually, that said, hey, you don't have to take an
Mhm.
RMD this year unless you want to. So I wouldn't count on that again necessarily.
All right.
You can't count on the government, right? On things like that. But if you saw an extreme drop, maybe that's something that would happen again.
Absolutely. And then last one that we got before this
Yeah,
happened,
sure.
and this one's kind of specific to employee stock shares.
Oh,
So
yeah.
clients who have employee stock shares. been wanting to liquidate for some time. Obviously when you have stock shares or you get restricted stock or options from your company,
Right.
that's going to grow to be a pretty big part of your portfolio. The question is mostly around, what's a good time for this? Is now a good time to sell it and just to kind of minimize your exposure to that? Do we wait for the market to jump back on that? What does that look like?
Yeah, it's a good question. So I would say it depends, right? I mean, that's kind of cheap answer, right? But it's like it depends. So if you're still employed by that company, and we've got clients at Apple and Google and Broadcom, Intel, all kinds of mostly tech companies. So and many of our clients are getting restricted stock units or stock options. So I'd say a lot of it depends on, are you getting more? In other words, are they still giving you more? Or are you still having additional vest each quarter? Because if that's the case, then your problem, maybe it's a good problem, right? But I mean, your problem actually is compounding over time. So coming up with some kind of a disciplined strategy, in other words, that kind of takes the emotions out of it to kind of divest over a period of time. Things can always get worse, right? I mean,
Yep.
you might have seen a huge drop, a 50% drop in the stock or something even more extreme, but that doesn't mean it can't get worse. We've seen it. We've seen stocks go to zero, right? So
Absolutely.
yeah, even from once great companies. So yeah, I think it's look at the individual circumstance, but be open to starting to sell, right? Starting to get out, but maybe not do it all at once. It may be that we have maybe a quarterly sell or something that's some kind of a non-emotional way to do it.
Absolutely.
All right.
Yeah. And then the only other thing I'd add on
Sure.
there is it's always, kind of industry recommendation to never have more than 10% of your total portfolio or value in any one company,
Yeah.
right? So
Yeah.
I think that should definitely factor into it as well. If you're trying to say, well, how much should I be selling? What does that look like? And then coming up with a dollar cost averaging plan to kind of get out of that or get to that recommended level.
Yeah.
Okay.
Yeah. Good.
Now, coming to these questions, and actually, I've been watching these and trying not to
Okay.
crack up
All right.
because you guys have been killing me with some of
Excellent.
this. We've been getting some real-time net, like market updates
All
on
right.
these.
Oh,
I don't
good.
know if you've been
Yeah.
seeing this, but
I have not.
yeah, apparently
You tell me what's happening
there's
right
been
now.
some news, there's been a pause on reciprocal tariffs for 90 days, according to the New York Times headlines, and
All right.
the market's had a nice little bounce up
Okay.
since then. So apparently we should do more of these. Maybe it's the Keystone effect.
Maybe.
Probably
Yeah,
not.
exactly.
But
Exactly.
all right.
I mean, yeah, watch out again in 90 days, right?
Right,
What
yeah,
would happen?
exactly.
Yeah.
So going to these questions on here, the first couple are really kind of talking about exposure to the current environment. Foreign investments, companies specifically involved with tariffs, versus kind of what the current administration is doing towards future prospects of infrastructure here in our country. What is our client exposure to those particular things?
Well, in a typical client portfolio, we would tend to have maybe 10 to 20% of a portfolio in foreign stocks as a category. Again, we're always looking at not overly concentrated in any one company or sector or industry, so that helps kind of smooth some of that out. But that being said, tariffs are going to affect everybody, right? It's not like you can just isolate it to certain companies or countries. Everybody. I've talked to small business owners too, even in the last few weeks, about tariffs, and just because everything is so interrelated. And I think that's what's causing so much upset right now is that the rules of the game were, fairly consistent, right, for quite some time, and that's all been put into question right now, at least until today. I guess the 90-day pause, right? But still, any kind of business owner has to go back and pause and say, all right, well, this was my business plan for the year, and how do I execute? Whether you're Apple or any company, how do I execute in this environment with this much uncertainty? So I think just diversification, which I know that's a boring answer, but just don't put your neck out and try to make a big bet either way, right? Where you're trying to pull out of certain areas or kind of make a big bet on a certain area. I think that's where you're more likely to get hurt.
Absolutely. And also to kind of piggyback on top of that, we maintain very well diversified portfolios. And so your exposure to any one market or sector should be fairly limited, right, inside of there. Where I don't think we're of the mind that we ever say, like kind of like we were talking about Magnificent Seven, right? Is we're never going to say, hey, there's a lot of opportunity in these 7 companies. Let's buy these 7 specific companies, right? We also don't do that with any specific sector. So kind of that disciplined, really not flashy approach to investing is own a little bit of everything. Yeah, you might have a little bit of exposure to that sector, but it's not enough to, send your whole portfolio into death spiral or anything.
Right.
Right.
Yeah, absolutely.
Okay. What is next? Let's see here. Putting politics, tariffs aside, someone approaching retirement, what's a reasonable approach to prepare for stagflation? And assuming that there is some kind of paradigm shift coming back into the country, right? Of manufacturing here again and whatnot. So what's a reasonable approach to prepare for this?
Yeah, I get a boring answer is stay diversified, right, and stay disciplined. But I mean, if you're going into a period of higher inflation, that's something you might be adjusting your financial plan for sure. If we think we're going in, because historically we use about a 3.5% inflation rate, for retirement planning. We might bump that up. Maybe in your situation we bump it up to 4 or 5 and see, does my financial plan still can withstand this? Right. And it could drive some different decisions as far as when you retire, how much you can spend in retirement. So certainly nothing that we can control directly. And who knows? There's so much uncertainty, right? And a couple of clients that actually do a lot with supply chain have kind of pointed out that if you're going to build a new factory, the soonest that thing is going to get built is probably 4 or 5 years, right? With anything, whether it's a robotic factory or there's a lot of people or whatever. So, which means, a new president, who knows what Congress will look like at the time. So even all of that is in question, and I'm sure we'll bounce back and forth. So that one is kind of unknowable, right? But again, staying diversified, I think will help protect. And diversification is free lunch, right? I mean, it doesn't cost you anything, right, to be really well diversified.
Exactly.
So we always want to make sure that that's the case.
Yeah, absolutely. So honestly, these next 2 questions almost kind of lead into each other in my mind. So, regardless of what side of the aisle you sit on with politics, yeah, it's, you can go one way or the other, how this feels or what the, rationale behind it is. And so, what is the value of having a trade war? And if the, overall idea is to bring manufacturing back to the United States, how is that going to impact things? What's going to be different this time?
Right. Yeah, and I get to some of it's short term, some of it's long term, and that's probably above my pay grade too, right? As far as trade policy and everything. But I mean, certainly, again, tariffs, they are a tax, right? So as far as how they affect everybody, they probably will, right? And it'll probably affect consumer spending. And again, even just kind of micro conversations, right? We've had with individual clients. We talked with one last week that works for a big tech company, and it was in their financial plan to buy a new car this year, and they said, "Yeah, we're not going to do that now, right? We're going to just fix the one we got." So you do that enough times, though, right? You do that enough times, somebody canceling the vacation, somebody cutting their Amazon budget by 20%, right? I mean, you do that enough, right? That's going to affect the economy since 70% of it is consumers. So, there could, I mean, no matter whether this works or not, right? As far as the trade policy and tariffs and everything, even if you're for them, right, over the long run, that doesn't mean that there won't be a period of disruption, right? That the global economy is not going to react well to. So it's just a matter of the severity and the duration.
Yeah, and I'd second that as well, is that, obviously there's going to be some pain points. And I think even the current administration has come out and said that is it's going to hurt.
Right.
There's going to be some
We got to
point,
take our medicine.
right? We got to take our medicine. That's right.
Yeah.
Absolutely.
Again, that's not us for or against. We play Switzerland here, right?
We just have to work within the current environment, right? And so,
exactly.
that being said, obviously, there's probably going to be some negative to it, but can there be some positive that does come out of this? I think absolutely. It's just one of those things economically, if we look at any of the history of this or how this has played out, it's going to take some time, right? And it's going to take some time. And if manufacturing does end up coming back to the United States and we start becoming a producer of items again, and assets and things like that, what does that look like? That's probably an entire thing just in of itself.
It is.
Webinar.
Maybe we'll do a tariff webinar. I think that could be coming up. You never know.
Yeah. So good and bad.
90 days from now, we'll do a tariff webinar.
Yeah, good and bad to come out of it, but it's yeah, we'll have to wait and see. Really.
Social security, and we certainly appreciate everybody's resilience too that you're hanging out. This must be really good. Um, question about social security benefits, and I got this one from another client the other day
Mhm.
too. As far as, hey, I was gonna, maybe I'm 66 years old, and I was thinking about waiting until 70 until I draw my social security benefits. But if the market goes way down for a while, should I consider taking social security benefits early, just so I won't have to take as much money out of my investments? And yeah, I mean, frankly, some people do that. I remember back in the financial crisis, for sure, there were
Mhm.
some people that started drawing early just because they said, not a good time to have to sell stuff right now. We want to take the pressure off the portfolio. So that could be a case where maybe all of our analysis about when you should draw Social Security and all that, as far as longevity, some of that could get kind of pushed aside, and you might just make the decision to start drawing it a bit earlier.
Absolutely. And that's one I would say too, if you're thinking about this or if you want to see the direct impact on your Social Security, I think that's pretty specific to every single individual.
Definitely.
So that would be one where I would say, hey, if you really are considering this and you want to see the quantitative data behind it, let us know. And so we can actually kind of run those numbers for you and see if weigh in, just say, hey, yeah, does this make sense? Does it not? Because that's going to be based on your individual situation.
Yeah. Yeah, and
Okay.
again, completely different seminar. We've had other clients that have asked about what if they cut benefits, or but what if there's some point in the future in the 2030s or whatever that they say I'm going to get a cut in benefits, so I want to take the money early. Yeah, that's something to consider, right? Because
Yep.
it's pretty likely, actually, at some point, sooner or later, that there's likely to be some pain there, especially if you're higher income, higher net worth. Yeah, it's pretty likely that there will be a time, right, that your benefits are lowered.
Absolutely. So I think really a bunch of these in a row right here.
Yeah.
Again, thank you guys for all the
Oh yeah,
real-time
these are
news
great.
updates. These are fantastic.
What's
But
happening now?
yeah, real time.
Yeah.
But yeah, I think just kind of talking about 90-day pause and stuff. Market's jumping up for the day. We'll see where it ends up for the day, obviously. But does it address the tariff situation? Not really, but again, this is part of kind of what we had mentioned earlier is yes, part of this is absolutely posturing,
Right.
right?
Definitely. Yeah.
And so we'll see kind of where it heads out.
Yeah.
Here is a good one. And how quickly can my portfolio investment strategy be changed? So if someone does say, hey, I'm not at that risk level anymore, maybe I'm down at this risk level, how quickly can that strategy be implemented, et cetera? That's obviously that would be, hey, give us a phone call. We can talk about what that looks like. We can talk about what that new risk is. But literally, as long as the market is open, we can change strategies on your accounts. We can place trades that can happen pretty darn quick.
Yeah. It's obviously a conversation, right?
Right. And
Yeah,
that'd be
that cannot
yeah,
be an email. We actually talk about it, and yeah,
good distinction.
but yeah, so but I mean, again, on that one, I think you really want to think about that though, and make sure that it's not, make sure it's a well thought out decision, that
Mhm.
emotions aren't too tied into it, because you'll get whipsawed, right? And I've seen that happen over the years. Is sometimes people will get whipsawed where they something's going on, and all right, we want to go lower risk, and then things settle down. I mean, maybe today's a day, right? I mean, the Dow's up 2,500 points, at least as of the comment that was made, right? So now maybe, oh no, I want to get back in. I mean, that's the temptation, right? Because the average investor does very poorly, right? We talked about that with the Fidelity study before. Average investor does very poorly because they get sucked into emotions. In other words, when everything is great, right? In a year like maybe last year, it's tempting to say, hey, I want to pile on a bunch of risk, right? When you're in a bull market, and then, I want to pull out in a bear market. But now you're breaking the cardinal rule of investing, right? You want to buy low and sell high. But if you let your emotions dictate that, sometimes you're doing exactly the opposite.
Absolutely.
So
Yeah.
yeah,
That's it.
your money, obviously your decisions, but we just want to make sure that we're kind of that buffer, right? To make sure that you're not falling victim to that.
Yeah. So coming down to our last few questions
Yeah.
here. Any investments in our portfolios we should get out of right away or move that you see as immediate red flags?
Yeah, I would say if you're overly concentrated, maybe you're on this call and you're like, yeah, I did have like a huge amount of my investments in Apple stock, or, in all in the Mag 7 or something like that. I've taken a huge hit. It's never too late, And again, maybe we're seeing a bounce right now that you say, all right, maybe, I made a mistake right before, but I need to get more diversified now. I think that's probably the thing that would stand out to me.
Yep. And then of course, I love this question every time it comes up.
Yeah.
Is now the right time to double down on the market if we have liquid cash? Is everything on sale right now?
Well, it was up until the last hour or so. Right.
Before we started this.
Yeah. I would not, even without the bounce that we're seeing in the market right now. Again, I think it's important to be disciplined and to not fall into that trap, right? I mean, this could be what they call a dead cat bounce, right? Where the market goes up a bunch after it's gone down a bunch, but maybe, all right, and next week it drops a whole bunch again. So I think if somebody had a chunk of cash right now, you really have to think about your true time horizon, but also consider that, maybe I don't go all in, right? Maybe it's a dollar cost averaging and where I'm doing it in a maybe over time sort of way as opposed to doing all at once.
Yeah, and I would add to that, and I love that the dollar cost averaging is such a great tool. You do it in your 401ks all the time when you're paying into those, but is the market on sale right now? Well, yes, obviously it's down from its highs,
Right, yeah,
right?
compared to what? Yeah.
Does that mean it's not going to go any lower? Not at all. It can definitely go lower.
Things can always get cheaper.
But you know what? I would say the real answer to that too is just like you said, dollar cost averaging in. Is there ever a great point to just throw everything you have into the market?
Yeah, it's tempting.
Depends on the long-term horizon. I guess it really depends on, is this money, is it long-term money, or is this money that you might need in a year?
Yeah.
Right? Or 2 years.
Yeah.
So a lot of factors kind of play into that, but I think the short, sweet, and safe answer is, obviously, yeah, you can buy at any time and things are not at their highs right now. But maybe coming up with a good dollar cost averaging solution to say, yeah, this money's probably long-term going to serve you better being in the market. Let's come up with a plan. And what does that look like for you specifically?
Yeah. So yeah, I think that's really important. Yeah, make sure you've got a disciplined plan and know your true time horizon.
Absolutely.
Yeah.
Well, thank you all for all
this
of
has
the
been great.
input.
Yeah.
And
thanks for all the audience participation. Again.
absolutely.
Makes it a
That
lot
was a
more
great one.
interesting for us. So that's
Yeah.
good. Yeah, we're always here though. If you've got questions just individually, clearly some people may not want to ask questions in a format like this. We're always available. Easy way to contact us is just communications@keystonefinancial.com. Certainly appreciate your business and your support over the years. It's during times like this, obviously, it's where that trust is built up, right? That we've been working together for a long time, and again, kind of like that commercial airline pilot, right? That you've got a person that and a team. Yeah, more importantly, right? You've got a team at Keystone instead of just a person. You've got a lot of history and a lot of bad markets behind us, and we got through all of them, right? They weren't pretty, right? But there are more corrections to come, more bear markets to come, even if this one settles down.
Yeah, absolutely.
Yeah.
Well, thank you all very much. We went a little bit over our scheduled hour there,
yeah,
but I think we got through a lot of good questions and whatnot. So any other specific things that you all need, you know how to get a hold of us, please. Josh at keystonefinancial.com, Jeremy at keystonefinancial.com. And we are always here for those questions.
Yep, absolutely. Thank you.
Take care.
Yep, have a great week.